Good day and welcome to another episode of Skytale Insights. Today with us we have Tedd Van Gorden, Director of Skytale Investment Banking, to discuss with us home health and hospice. Ted, very happy to have you on. Would love if you said a quick hello and also maybe give a little bit of your background in this space.
Absolutely. Ben, thanks for having me on. It's a pleasure to be on the podcast with you for the second time, I've just learned. Feels like the first time, though, in this room.
It's been a while.
It's definitely been the first time in this room. As you mentioned, Ben, I'm a director in Skytale's Investment Banking Group. I've got well over 10 plus years in investment banking experience. Most of that has been in healthcare. Prior to joining Skytale in 2022, I was a vice president at Ziegler. They're a healthcare-focused investment bank, and a lot of the activity and work that I did, whether it was M&A sell-side or buy-side engagements, capital raise engagements with bank debt, Fannie Freddie, FHA HUD, so agency financing, as well as capital raise on the equity side, was in the senior space, including home health, hospice, skilled nursing, assisted living, you name it, we looked at it, we touched it. We have experience in it at the time at Ziegler. And so from that, I'm drawing upon that experience as well as the experience at Skytale, where we really focus on anything in the healthcare space, founder-owned focus, experience. And in addition to that senior care and home health and hospice experience, I have extensive experience working with clients in the healthcare clinician services space or provider services, as well as consumer. So drawing upon that really broad and deep well of experience to have this conversation here, and I'm really excited to kind of talk about home health and hospice.
Yeah, I'm excited as well. I think it's a space we continue to hear about, I imagine for a few reasons, but I think you'll let us know that. I oftentimes like to start with a definition. So, generally, how would you define, when I say home health and hospice, what does that mean? What are some of the maybe key segments within the space that you think are important for people to understand as we get into this?
Yeah, absolutely. I'm happy to chat through it because a lot of people may think that there's a ton of overlap when we say home health, hospice, but there is very distinct differentiations between the two. And it really comes down to the revenue and expense cycles for each, because there's differences in the payers, there's differences in who's providing the care, where it's being provided. And more importantly, what really distinguishes it as well is the acuity of the care. So ultimately, in my mind, I like to think of it along an acuity spectrum. We're talking healthcare, so the more acute, right, the more healthcare involved it is. So on one end, or the top end of the funnel, I like to think of it for home care. So those are companies and services that are providing non-skilled services to seniors or children in the home environment. You think about it as providers helping with ADL, so the assisting for daily living. Then you also, on the other end of the spectrum, is more skilled care, home health. So in the home environment being provided by clinicians. So that could be skilled nursing services, therapy services such as PT, OT, speech therapy, all of that being provided in the home as opposed to a traditional skilled nursing setting or assisted living setting. And then beyond that, the other end is where we're seeing more increasingly is hospital and home services, which is kind of a growing segment within this market, where it's very acute care being provided in a home setting that is similar to hospital services, but beyond the scope of your traditional home health services traditionally thought of. And then at the end of the life cycle for patient really is the palliative care or hospice care. So that's helping patients kind of through the final phases of their life. So that's kind of the end of the funnel, if you will. So I know that we kind of throw around home health and hospice. That's the spectrum of services and the wide variety of companies that we're talking about today.
That's very helpful. I learned a few things there. So, we have that definition. Now, as far as the market that we're talking about, what's the size of it?
Yeah, I would say the latest statistics that we track and that I see is, in general, that whole pie is roughly 150 billion in size and growing. 100 billion of that, the larger pie is in the home health side, and then the 40 billion roughly to 50 billion is hospice, depending on who you're looking at and who you're talking to.
Now, with with whether it's aging population or regulatory, whatever it may be, are any of those spaces growing faster than the others, just given where we are now?
Yeah, I would say the pie as a whole is growing rapidly just simply due to dynamics that you referenced to. The silver tsunami, if you will, is what it's kind of referenced to in pop culture. But it's talking about that as the boomer generation, who are my parents, as they approach retirement, are in retirement, are approaching 70, 80 years old, that segment of the U.S. population is growing at a rapid pace. And so that oncoming wave, which has been predicted and known for a long time, is what's driving a lot of the growth, not only from a nominal, but also from a count perspective for home health and hospice.
Interesting. I'm surprised you don't call me the silver tsunami. I thought you were referring to me for a second.
I'm pretty sure, isn't that a reality TV show too?
It might be. I don't know. It should be, if not. So Tedd, now moving into, some of the investment in this space, what we're seeing, you recently wrote a really great piece on private equity's move into home health and hospice. What's driving that? And I know it's been consolidating for a while, so maybe two questions. One, what's driving it today? And it has been consolidating, as you mentioned. You've spent time in this space. Maybe how consolidated is it? How much white space do we have left here?
Yeah, I think that the consolidation in the industry, and by consolidation we mean how long have private investors or public investors, non-founder-owned business like transactions have been deploying capital into home health and hospice. It's been going on since the late 90s, early 2000s. Really, the early to mid 2000s is when it really started in earnest, but it continues to grow as an industry itself, and so even though that consolidation pipeline has been happening since the 2000s, because the market has grown and because the silver tsunami that we mentioned is ongoing, the consolidation within the market is still, if we like to use in investment banking and in finance, a baseball analogy, middle innings. So let's think about like fourth to fifth to maybe sixth inning. And within the spectrum of acuity and care that I mentioned between home care, home health, hospice, there's a difference in when the consolidation phase is happening. So home health has been happening in consolidation in home health a lot longer than hospice, as well as as I mentioned and alluded to, the hospital at home space is probably earlier innings than home health. So even though we let's just at a bigger picture, fifth to sixth inning for the whole industry as a pie, that consolidation timeline isn't consistent within it. So there's a different spectrum. And then to really address why does private equity like home health and hospice? Why are they deploying capital? What's the reasoning behind there? A lot of that is, as we mentioned, the consolidation opportunity. It is a very fragmented market. And that fragmentation, even though, as I mentioned, because consolidation has been happening, continues to remain, is simply because the second point is the growing demographics, the underlying demand for these services from a sheer population standpoint also directs investor attention and provides opportunities. Another reason why private equity is interested, along with the fragmentation and just the underlying demographics, is the opportunity that private equity sees for multiple arbitrage. They understand that because it's so fragmented, that they can acquire assets and then sell them for a higher multiple. So that's where the multiple arbitrage is driving it. And then finally, a more governmental or maybe macro perspective over the long timeline is that there's just payer alignment for home health and hospices. Traditional mediums and traditional places where seniors got care, you think of it like a skilled nursing home or assisted living or senior housing, has become more expensive. CMS, the federal government, state governments, private payers are all understanding that there is a payer incentive or a payer alignment to provide those more provisions of care in a home environment where it's a little bit cheaper. And so that natural incentive is also driving reimbursements in the space towards this industry that were traditionally in skilled nursing or senior housing spaces. So you combine all that, it creates a really attractive industry for private investor interest. And so from a founder perspective, if you have a company in the space, it's worth considering, there are probably investors out there that are taking a look at your company.
That's great. And so that covered very well from macro, and you got a little bit deeper as well as far as, why is there interest in this market? When you think about, what drives returns, right? So, as a financial sponsor, this is why I'm investing. Okay. What's driving returns then beyond, once someone does invest in this space?
Yeah, there's several things that we can really dig in on there without spending a whole podcast on it. I'll try and do it justice by being high level and maybe getting deep where we can. I mentioned the multiple arbitrage opportunity in the space. So to get more specific on that, the way private equity is looking at it is that they probably look at an opportunity to acquire an add-on acquisition in the home health and hospice space, add-on companies, or maybe a platform investment where they can buy in at maybe 4 to 6 times multiples, aggregate, professionalize the business, find areas of opportunity that we can kind of touch on later on what those specifically are. But at the end of it, they then are able to sell that platform, that somewhat finalized product to another private equity investor or to a public company or to a healthcare system, and sell that and exit at 10 to 15 times, for example. So mid-teens, or maybe even high teens if it's a large in scale. So that multiple arbitrage is really what they're getting at. So that's one of the things that's driving returns in the space. In addition to that, and as I mentioned, so when they come in and do these investments, it's the operational improvements. So it's increasingly important for these organizations to not just aggregate scale. They need to be able to demonstrate to drive those multiples that they're able to acquire practice and improve patient outcomes, improve not just the financial metrics, but the clinical metrics as well. So their buyers are really hyper-focused on that at the front end. And then beyond that, it's really just the fact that the industry itself has a lot of underlying dynamics that continue to allow growth within it just from the demographic that we just spoke to.
That's great. Now, if we go maybe a layer deeper, maybe let's talk about things around an actual deal. What's a deal structure look like? So right now I'm trying to get into, if I own my business and I want to understand a little bit if I'm interested in this, like what does a typical deal structure look like in this space?
Yeah, traditional structures is you're not going to get 100% cash at close. So for founder-owned businesses, a lot of the private equity investments, they want to make sure that there is alignment post-close such that when the private equity company comes in and they make these operational improvements, that they're working alongside the founder owner to do that. And they want to ensure that there's still those incentives that a founder owner has today where they are striving to improve, increase profitability, make more money theoretically. That dynamic lasts. So the way they do that, there's a couple of tools they can do. The biggest one is going to be rollover equity. So essentially, some of the proceeds of the transaction, they're going to say, hey, great, fantastic. You've got a great business here. Let's partner together, make it better. And we're going to give you some cash up front, but we're also going to require you to maintain some form of ownership in that company going forward. That ownership will look different. It will be in a different type. It could be at the top parent entity. It could be at your current company. But the alignment thesis is the same. Like you will still have skin in the game. Another way is for contingent structures. We think about that as ways to ensure that there is a payout contingent upon a certain level of performance, maintaining profitability, maintaining revenue. That's another thing that could be considered here. That will be an alignment tool to ensure that the owner continues to stay on, that the business doesn't get disrupted, that it doesn't fall off once the private equity group comes in. And that's not unique to home health and hospice. That's kind of a universal tool that private equity uses across industries, but those are definitely dynamics that we're seeing in this industry.
Great. And, touching on some of the last pieces you mentioned there, If I am an investor, or if I have my business even, and I want to know, what in your mind does a really high quality business look like? What does that look like from a buyer perspective?
Yeah, absolutely. So there's a lot of things that buyers like to look at. I like to break it down between revenue characteristics, expense characteristics, and then most importantly in healthcare, you have clinical and regulatory characteristics as well. I mean, clinical and regulatory have impacts on revenue and expenses, but we can think of that as something somewhat different conceptually. So from a revenue standpoint, they're going to be looking at things that typically point towards the quality of the revenue and the volume of the revenue. So from a volume perspective, you have things like average daily census and the trajectory of that average daily census. So like how much and how many patients or how many individuals are you treating, are you seeing on a daily basis? Is that growing? Is that declining? Where is that? Average length of stay is another one that they're going to look at as well for the industry, of how long the patients are with the platform, with the company. Is the revenue stable? Very short stays, right, can also imply complications, can also, which then gets to the regulatory and reimbursements. Payer mix. So where is the money coming from? Who's paying it? Is it private? Is it Medicaid? Is it Medicare? Is it Medicare Advantage? All of those things have different risk profiles, different returns. Certain payers pay more for the similar services than others. And so that definitely is what investors are looking at. So I think payer diversification can be good. You don't want too much within your one bucket. Referral diversification too, because referral patterns are important for this industry. Where are the patients coming from? Do you have good inroads and networks with hospital systems, doctor groups? And so are you dependent on one referral source, or do you have a wide variety of referral sources? Beyond that, it's the geographic market. So where in the U.S. are you located? That has implications for the reimbursements. Certain states have better Medicaid or reimbursement qualities, better demographics, easier access to business, consolidation. So states like Texas, California, Florida, there's been a ton of home health and hospice, say market penetration, if you will, where other geographies, there's more green space to grow. So competition comes along with that. And then another one would be the management team. So from a founder-owner perspective, that management team could be just you. So it's a team of one. So is it a team of one? So there's probably a lot of risk of that founder-owner, something happens to them. They go disappear, you go to Bora Bora, or you have a health event, what have you. That's a lot of risk. So a lot of eggs in one basket, if you will. And valuations are always, conversely related with risk. And so the quality of the management team, the dependency on the founder owner is a big factor as well in terms of quality platforms.
That's great. That was a comprehensive list. Now, if I'm a founder owner, where would I maybe over or underestimate the importance of maybe two or three of the things that you said that to you are extremely important from a value perspective, that you maybe see some initial misalignment if I'm selling my business? What would surprise me about, hey, these are extremely important?
Yeah, that's a great question. And we just listed off some of the many, factors that kind of point towards value. And there are a few that I didn't mention that I can probably shout out here in terms of prioritization. You only have so much bandwidth and time in the day if you're a founder owner. So how can we help them think about what's a priority? I can kind of think through when we go through an opportunity in the home health space and we're talking with investors, where are they focusing first? First question is going to be on size. Like, how big is it? How much in revenue, and importantly, EBITDA, because then they can figure out margins from that. So obviously more scale, more size, more revenue, more EBITDA, the higher the valuation. So that's kind of a no-brainer. Probably not, busting any minds right now by saying, hey, a bigger company is more valuable.
Increase your revenue.
Right? Increase your revenue. So easy, right? So let's get that out of the way. Let's just address it. That's the first question they're going to want to know. Then when they dig deeper, payer source, payer diversification is very important. I can say that there are a ton of amazing operators out there that are extremely qualified and have Medicaid dependent companies in the home care space, for example. And they make great businesses. They're doing great services for the public. But unfortunately, the way investors look at it is that, they are more attracted to Medicare, private pay, or Medicare Advantage even over Medicaid. So if you are highly dependent on one type of payer, you're dependent on that source of income. So diversifying away, and unfortunately, Medicaid is in a tough reimbursement environment at the moment. And so that's just another thing to think about. On the expense side, I didn't really address some of the value there that I do think is valuable to kind of talk about, to help think about, but really it's caregiver turnover, or provider turnover, or employee turnover overall. The biggest cost, right, in a lot of these businesses is payroll. And so having a good payroll, having a quality caregiver turnover, employee turnover ratio that's low, right, meaning that you have long-term employees, you don't turn over, which is going to be expensive to recruit, train, hire, just not only the lost time in providing care, but just getting them back up to speed. So that also speaks to a quality culture within the company as well. A good company with a good culture has a low caregiver turnover ratio. So that could be an indicator as well of an overall better, more valuable company than an otherwise. So that's another one that I would really focus on as well. And then beyond that, on the regulatory and clinical oversight side, your survey history, your readmission rates, if you're in the home health space, things that are more, look at whether or not you have your discharge rates. Those are what they're looking at in terms of the quality clinical outcomes that can have impacts on reimbursements in the environment. And more importantly, now that in the news, there's been a lot of discussion from CMS about fraud in the home health industry. And so buyers, investors are hyper-focused on practices with strong clinical history and survey history. And so having that in line, having a clean record is very important.
Those were great, which, as you were talking, especially toward the end there, it sounds like, a lot of focus on regulatory, some operational excellence. You mentioned ethics. So with that, what are some diligence landmines that I should be wary of if I own my business or if I'm buying it or selling it?
Great question, Ben. So what are some diligence questions? Those are the things that we like to think of up front because they can be landmines that blow up deals right before closing and wasting time for your client, the buyer, the advisor. Like, that's a no good story. So how can we think about in the industry, like what are those landmines and how can we help the audience look internally in their organizations and maybe course correct if they are on the wrong side of those diligence landmines, or continue to stay the course clear of those landmines and not step on them. Within the hospice industry, like one of the things really that their buyers look at is the cap exposure. So there's a limit to the per beneficiary billing cap with it from CMS. And so as you approach that cap, right, that percentage, the closer you are to that, like the less likely you are to continue to get reimbursements from CMS, or they claw that back. So that can represent a financial liability. So if you're not tracking that in the hospice industry, that's something that buyers will dig in on. Like they've asked that for opportunities in the hospice space before, so something they keep in mind. Survey deficiencies and conditions for participation violations. So they're going to be pulling public access records from state regulatory bodies, federal regulatory bodies, and looking at patient safety, looking at the documentation around and supervision documents. So survey quality is utmost important. And hey, every practice is never going to have a 100% clean record. So it's okay to not have a clean survey record. It's a matter of understanding what it is and being able to talk to it with confidence. If something went wrong, here's what we did. Here's what we learned. Here's how we course corrected. Here are the SOPs or the clinical processes that we put in place to such that if it does happen again, we can course correct faster or prevent it from happening. Undisclosed OIG or Medicaid fraud. So fraud. That's a particularly big one now that there's been a lot more news in it. And I know from talking to third-party advisors like CPA firms that are doing a lot of activity in the space, investors are spending a ton of focus upfront looking for to ensure that there's no fraud undergoing in these acquisition opportunities. And then I think another one is just a key person risk. Is there an individual within the company or from a referral standpoint or from a payer standpoint that represents oversized risk that if that individual were to go away, if that payer source were to go away, that referral source were to go away and disappear, or something were to change, what is the fallout from that outcome? Is it going to devastate the business, or is the business going to be able to maintain and continue on?
It's a good list, Ted. Sounds like a lot of landmines there. If I'm a founder owner and I'm maybe interested in going through this process, selling my business, let's say in 2-3 years, what should I be doing today? What are some things to think about so I can be ready?
Yeah, absolutely. That's a good question. So I like to steal a saying from our friends over at Birded Auto when they talk about this in all industries and all transactions is get your house in order. And so I wholeheartedly agree. I think it's a good analogy when you sell a house. Not the first thing you do is you don't have an open house. You work with your realtor and you think about how to best stage it, how to clean it, get the yard in order, get the internal house in order, maybe pay for a cleaner if that's not your thing. But it's an important thing. It's the same thing with the business. You want to make sure that you know where your documents are. You are able to understand profitability. Like, what is your EBITDA? Even if it's not 100% accurate, having an understanding and being able to speak to it and understand your financials is important. Another thing is build the management team around you. So from a founder owner, right, that's what we're talking to here today in this space is, how important are you to the business? You're obviously very important because you founded it, but are you able to take a vacation and, obviously you'll get emails and phone calls, but will the business continue to run without you, right? Like that's the dream, is to have a business that can run autonomously without you. So that first step requires building a solid management team around you that can execute on the business without you. So that's another one as well. This to kind of more talk to a lot of the points in terms of driving value in the space that, one of the things that you can look to in the next 2 to 3 years, diversifying your referral sources, diversifying your payer sources. That's a good step. So if you have concentration in, top 5 referral sources, maybe think about, okay, how can I think about getting more referrals into the business? How am I acquiring my patients? And just sit down and think about how can I really diversify the risk from that. And then finally, compliance issues. I mentioned it before, no one's perfect. Things are going to happen. It's understanding, do we have a course correct system that's standardized, that's taught throughout the company, that is understandable, communicatable, so that when things do go wrong, corrections happen fast and you can speak to them is another thing. There's a ton more that we can kind of dig in on, but those were the top ones that came to my head.
Those are some really good ones, some very good points. I like the house in order thing as well. I think it's a very simple and direct way to think about things. Now, if I'm put on the Ted crystal ball, or take it out rather, where are we going to be? You talked about some of the trend lines that make the space attractive, why it continues to grow, the silver tsunami, among other things. Where are we in 2 to 4 years in this space? What should we expect?
Well, if I had a crystal ball and I can predict, you and me, we'd be trading and, I'd be placing bets on Super Bowl winners and things of that nature. But, how do I see the industry changing in the next 3 to 5 years? Because, 3 years ago, was what, Ben, 2023. So
wow.
There was a ton of aggregation. We were still post-COVID interest rate environment, a ton of consolidation, and now where we are today, where interest rates are so different, but the industry is still consolidating, still chugging along. I continue to see that within the home health and hospice industry, this continuum of care. So a lot of the acquirers in the space are looking to add that depth of service. And so the continuation, I would say, that for lack of a better word that can come to my mind, of the continuum of care for platforms is going to really drive a lot of investment activity. And so adding, companies that provide care to seniors, like senior housing companies, investing in home health, investing in home care, that's been going on for a long time. So I still see that as a valuable play and way to continue. Another one would be the increasing demand for hospital at home services. That's something that's interesting. We're seeing in other healthcare verticals like concierge, clinical care, being very important. So access to medical care outside of your traditional hospital or nursing home environment will continue to be an important factor. So if you think about at the very end of the acuity spectrum is hospital at home care. So I continue to see that as something driving. And then it's impossible. I mentioned the Super Bowl earlier. There were about 50 different ads for AI. But so technology and how does AI and how does tech really penetrate and increase and improve the operations of home health and hospice? I just continue to see that being more and more integrated within these companies. And so even though there's a ton of professionalization opportunity, that doesn't mean private equity needs to be the one doing it. So, since that's something they're going to be doing, it's very considerate of a founder owner to do it ahead of time and, capture that value themselves as opposed to give it to the private equity firm to kind of create. And so I continue to see that drive the industry forward and improve it. We know of a couple firms that are using and leveraging technology to help improve the clinical outcome. I know having my grandparents receive home care and home health services in their lives before they passed away, the importance of communication. And so the digitization of that and providing technology to a lot of the end users in the space, allow them being the adult children and improving patient outcomes through that is a great opportunity for investment in the space and for founder owners to kind of differentiate themselves. And then the question mark, really the big question mark is where's the reimbursement rate environment going to be? So we saw, from the mid 2010s until the late 2010s and early 2020s, the reimbursement rate was very favorable in home health and hospice. I believe in 2026, CMS, it was a mixed bag. So I think home health received a reduction in their reimbursement rate, whereas hospice received an increase. We're seeing pressure on the Medicaid side from recent regulatory changes. And then we're also seeing an increase in Medicare Advantage, which is a lower reimbursement rate than Medicare. So where is that going to shake out? Question mark. I don't know. I wish I had that crystal ball so I could tell you, and then we can take that bag of money and deploy it today.
That's right. Okay. A lot of good things out of that crystal ball. Tedd, is there anything that I should have asked or that you would like to touch on before we wrap up?
No, I think we tried to cover as much as we could in this conversation. There's a lot more that we can kind of go in depth on. I think that maybe the thing about it is like, when should you think about selling, if ever? The importance of advisors. We obviously, like, bias being an investment banker and being an advisor myself. We always get asked the question of, when's the right time to start talking to third-party advisors? Should I go with an advisor if I'm looking to sell? I would say that, we've talked a lot about the private equity interest in the space, and a lot of the folks that we talk to in all of healthcare, regardless of industry, they're getting a lot of inbound from private equity. And as important it is to surround yourself with quality management team members to help diversify that risk. It's as equally important if you are interested in selling to do that with advisors, be it accountants, whether lawyers, investment bankers, wealth advisors. For a lot of people, you only get one opportunity. There's a lucky few that are serial entrepreneurs that can found successful businesses until the cows come home. But for a lot of people, you only get one shot. And so, obviously I'm biased and I'm an investment banker, and we have an incentive to advise people. But from a personal perspective, we do think it's important that you have representation. So, it doesn't have to be Skytale. Would love it to be Skytale, of course, but that's extremely important. And so when is the right time to talk to an advisor? I always think about that as two questions. Is the market ready, and is the company ready? And then beyond that, if the company and the market ready, okay, when do I start that conversation? So is the market ready for all the various factors that we mentioned earlier on the podcast? Yes, absolutely. Is the company ready? Well, that's individual to you. And to understand that, it's best to start talking to an advisor. Even if you're not ready to go and sell today, it could be a year or 2 years from now. We have conversations with founder owners all the time that aren't ready or looking to sell their business today or tomorrow, but maybe eventually. It's good to have that conversation because that individual, that advisor, that investment banker can parachute in and provide some great perspective on how your company stacks up against the industry and against benchmarks, and work with you to grow, make changes, and really identify ways to create a healthier, more valuable business. And so from that perspective, to help you understand, is the company ready? We advise our clients to start those conversations today. There's no financial commitment. It's a conversation. And so why not gain that perspective, even if you're not interested in selling right away?
Very good. Yeah, very, very good tip there. And we see it with our data, like empirically, the advantages of working with advisors across the board, who do this for a living. Thank you so much, Tedd. How do I get a hold of you?
You can call Ben or you can reach out to skytalegroup.com. Our emails and our contact information is on the website. I'm happy to jump on the phone call, happy to answer emails, would love to connect. And so that's where you can reach out to us.
Thank you. And thank you again for coming on, Tedd.
You're welcome.
And thanks for joining us for another episode of Skytale Insights. We hope you got some good information out of this and would love if you follow us.